No, greatness takes time. All right. So I appreciate everyone's understanding while we got the stream set up. Wanted to make sure I had a few things out of the way before the actual meeting so I could focus up here. But good to see you all. Good to see you all. He said, where you at? The volatility is already here. El Nawa, you already know how to trade. You already took the class. You know the strategy. What you waiting on me for? Brother, it hit. The trade already hit. Let's take a look at the before and after, just so we can kind of go through these details here. God, if only there was a place where somebody would call these trades in advance. Like, if only there was a place where somebody would call these trades in advance. So where are we at here? This is today at 11 a.m. Man, you guys have been active in the chats. All right, this is why we have this channel. Good stuff. That's not it. Right there. Okay, so what we're looking at right here is, oh my God. Obviously, the long and short position is blocking the actual price here, but it says 301. So that was the entry down here was 17,300, 17,300. Market came down this morning and started to consolidate, came very close. It went to 310. And so I did end up entering a small order here. Then the market came down and hit 17,300. So I entered another position here. And then I was waiting for potentially during the press conference for maybe one more dip down to 230 to enter one last position. Now, I did take partial profits along the way because I'm trying to reduce my risk in case I get hit with massive drawdown here. But there's two ways that you can play this is if you already took these entries, you can continue to layer every time the market comes back. Or if you want to take partial profits on the original trade and then wait for that potential re-entry, you can put in a whole position here. So if you're already risking money, you can't over risk by putting the same size position or just like doubling up your risk on a second trade. If you cut some of your risk on the original trade, so let's say that you close partial profits, reduce the contract size, reduce the position size as a whole, then you have more ammo to play with to be able to enter that second position. Okay, so instead of over leveraging and doubling up your risk, make sure you guys have a consistent risk strategy so that you know what you can afford to lose, and if worst case scenario happens, what your kind of downside protection is going to be. So no surprises. We've been talking about this for months. No change to the Fed funds rate. Big surprise here. So obviously everyone was expecting this. We were watching the CME Fed Watch tool all week. The chances of a rate cut were about 3%, maybe less. We got an FOMC statement, which we're going to check out here in just a second. And then, of course, we have the FOMC press conference in about 15 minutes, which we will cover here together live. Live. So I just love your comment, Brody. Powell ain't the same without you. Brother, imagine trying to watch this dry ass press conference without your boy, right? They said, who are you? Bro, who am I? But a real question is, who am I not? Right? I'm young, handsome, successful, wealthy, intelligent, technically skilled, right? A specimen of human performance. You want to add some to the list? You guys want to gas me up in the chat? Let me know. All right. All jokes aside, if this is your first time on the stream, this is what you can expect. A lot of shit talking, but we keep it productive and we're always focused on the ultimate goal, which is taking quality trades, managing those positions, and making sure that we don't allow like just time and waiting for the trade to distract us from the overall goal. That's why I keep things entertaining, because if we're going to sit here and watch paint dry, this is where overtrading came from for me. I'd be sitting there waiting for a trade to hit target, and it's like an hour, right? 20 minutes in, I'm out here taking scalp trades in between zones. I'm out here taking little scalp entries and shit. For what? So learning how to keep yourself occupied. Patience is learning what to do in the meantime, to keep yourself distracted. What am I going to do in the meantime? That's what patience is. Right? It's not floating off the ground and really just being able to willpower your way through it every time. So, long story short, 17,300 got hit. I'm expecting longs to jump in here. There's two scenarios, which is we have either just a clean push up or some kind of like a little bit of a dip and then push up. My second scenario is a very aggressive drop. when Jerome Powell kind of mentions that inflation is starting to turn back up and there could be some potential challenges later this year. Now, ultimately, I'm still bullish. So after that dip, I'm expecting a massive resurgence. There's three main reasons why I'm bullish on stocks, especially because of what Jerome Powell is going to say. Now, if you're looking at the traditional media, so again, I always mention Bloomberg, Yahoo, CNBC, and those. They're saying that because inflation's starting to tick back up, Jerome Powell may start to hint at rate hikes, and then he's just going to overemphasize how bad the economy is. And so everyone's sort of starting the recession hype. Well, there's no recession hype. Okay, Jerome Powell's going to get up there and say a few negative things because the economic situation really is not improving. Now, the reason I'm bullish, we had a lot of earnings reports, Facebook being one of them. We have a lot of earnings releases today, even though they came out slightly less than expected, still positive. These large companies are still growing massively quarter over quarter, and that's only going to be positive for the stock market. Another big reason is I think Jerome Powell is going to start to mention the loosening of quantitative tightening conditions. And so quantitative tightening is them basically taking a vacuum and taking money out of the economy. So reducing the amount of money you're taking out is stimulative. It's basically the same as introducing money to the economy. So, in my humble opinion, I think that we see a bullish stock market. The underlying fundamentals are starting to get shaky, but employment's still strong. And by the way, we're gonna do a whole session one day on just the employment report because I was looking at a few things, how many jobs they got added under Biden's presidency. Because I saw Nancy Pelosi talk about how many new jobs, like a record amount of jobs added under Biden, and I was like, "There's got to be something wrong here." I went to go look at it. It is a record amount of jobs, but you guys know why? It's because everyone had to pick up a second job just to be able to keep up with the prices at the grocery stores, and so it fudges the numbers and makes it seem like there's more open jobs or there's more available work. However, it's just people who need a secondary income. And so we're going to go through and look at the labor report and see where are most of the open opportunities? Where are those open jobs? Is it individuals who have to get a second job that's leading to the great employment numbers and this great record number that Biden is claiming in terms of the new jobs introduced? Or is it genuinely a positive economic situation and we're all just catastrophizing all the time? Because doomsday is more fun, right? I wake up here and I show up with you guys and I say, God, world's gonna end. Today, Jerome Powell is gonna hit the stage and everything's gonna be done. Today is the most important day of all time. Nothing matters beyond this day. I haven't even checked the YouTube numbers. I can guarantee as soon as I even started down that rabbit hole, we just gained 50 more viewers on the stream. But if I come here and I tell you guys, this is kind of what Bob Elliott always tells me every time I text him. I'm like, but Bob, look at this link I saw online about this thing that could be a massive problem. Because you guys know I'm a doomsdayer. I'm always tripping out. Send it to Bob. Bob's like, and Bob always tells me the same thing. He said the labor market is secularly tight and we're in a sustainable market environment. He always gives me the same kind of catchphrase. He's telling me, if you look at the historical trend, we're at one of the best economic situations we've ever been in history. Take the inflation problem out of the question over the last 2 years. If you look at it today, inflation is still at a manageable level, but employment is at record lows. So we always talk about it, 3.2%. That's the low for unemployment. That's the lowest that we've seen historically. During recessions, it goes as high as 7, 8, 9, 10%. Right now, we're at 3.9 or 3.7% unemployment. We're near the record lows. We're near the support. If this was a chart of unemployment, if this was 0% unemployment and this was 100%, we're sitting so close to the lows. That's good. That's what we want. We want to be at a positive work situation because the more money people have, the more confident they feel about the future expectancy of their ability to spend, the more likely they are to spend, the more likely for the economy to continue to be stimulated, and we have positive economic growth. People lose jobs, people get scared. That's where recessions really start. So for now, the underlying economic situation is positive. Are there cracks? Yes. Are there big issues? Sure, but those are 7, 8, 9, 10-year issues. Today, I think the Fed has it, I don't say under control, because this whole shit is just completely unsustainable. This is just like managing the sun, right? Wear sunblock. That's about the best that we can do, but it's better than nothing. Okay? Jerome Powell is going to hit the stage. talk about reducing quantitative tightening conditions, mention higher for longer, so higher interest rates for longer in order for us to combat the inflation problem. And one last thing, okay, what can we expect from him? But I don't think he's going to panic the markets because there's a few things he should say, but I think he'll most likely just continue to string people along into thinking that there will be rate cuts later in the year. So he might even just straight up say July and June, no rate cuts. And everyone's like, but we thought, but I think the market's all like a lot of the selling pressure that we saw was the market sort of accepting that we're not going to have the 5 rate cuts that we were expecting this year. And so instead, I think Jerome Powell is going to be very clear, June, July, no rate cuts. Then we're going to come back in the October meeting and the November, December meeting. I think he's going to make people think that there's a September surprise or an October surprise. And then we might get a rate cut in the last 2 months. I expect Jerome Powell to cut rates in November, December. Only 2, maybe 1, depending on the situation. But he will lie and, at least make people, pretend and make people believe that we're going to have more than a few rate cuts. Put a 1 in the chat if we're still on the same page. Hey, bro, does the Fed funds rate have a direct impact on the direction of NASDAQ? Direct impact. Good question. I like how you phrased that. God, that's a tough one. I would have to say no, directly, but indirectly, 100%. And there really is no difference for me because if, let's say, like just one example, interest rates affect the bond market. Bond market is counter correlated with the stock market. Typically, folks are either doing one or the other. Fed funds rate affects the dollar because it basically determines the supply and demand of that currency across all the central banks. If the interest rate's more attractive, maybe it promotes more borrowing. He said, "What's up, Tony Stark vibes?" The fuck are we talking about, Tony Stark vibes? I don't know. I like it. Yep. Definitely just before Christmas. We all know the Santa Claus rally. Jerome Powell delivers a Santa Claus rally consistently every single year. Right? Whether it's bearish, whether January 1st he's going to basically burst the bubble, or whether we have what happened this year, January 1st was that turning point and we just flew. He's going to deliver that December surprise. Y'all understand? Young kid said, what the fuck's wrong with you, man? Why are you out here just on? How do you get good with fundamentals when it comes to NASDAQ? Dude, become obsessed. Become obsessed. Okay? That's the only way I can tell you guys. When it comes to making money trading, you don't have to love the shit. If you guys learn the strategy, which by the way, congratulations everybody who secured their seat to the NAS 100 masterclass. You have 4 hours to register for your seat. 4 more hours. To learn a strategy, it doesn't really matter how much you love trading. If you're willing to put in the back testing, if you're willing to put in the time to really understand the system before you even take your first trade, if you really build out a coherent plan, coherent, not mumble, jumble, not fucking chicken scratch, a coherent plan. Here's what I'm going to do when this happens. Not might, should, could, maybe, almost. Real plan. You ain't got to love this game to make money. Just fucking follow the system. Ask the Chart Addicts members. Now, when you love the game, that's where you start getting more interested in how the world works, finding directional trades, using fundamentals. And to really understand fundamentals, you gotta love it because this shit is not fun. This is not something that you do. Really, you don't even have to do it as a necessity. I used to tell folks, you have to understand the bigger picture. What's the bigger picture, the direction? Is NAS still bullish? If yes, cool, don't bother me. Is NAS bearish? Okay, good, clear, don't bother me. So you got to have an understanding of the higher time frame directional bias based on market sentiment and some of those fundamental factors that impact the overall economic picture and fundamental sentiment. But that's all for fun. Okay, everything else, day-to-day data releases, trying to trade and predict markets based on individual news releases, all that shit is for fun. Understanding how the fundamental picture works in synchronicity, the mechanics and the fun and the like really building a plan around it, that just takes a lot of studying. Go to the charts. I'll give you an exercise. Let me not make this shit sound like it's the end of the world. I'll give you an exercise, and if you're willing to actually go do this, you will. This is going to be a life-changing experience for anyone who's actually committed enough to do this. It's not that fucking hard. Go to Forex Factory, go and click on the FOMC press conference, okay, or the Fed funds rate. Look at all the previous meetings. Write down those dates, okay? Go to your NASDAQ chart and go back to every single one of these dates, okay? And basically just see what happened, and you'll figure it out. Or if you don't want to do any of that shit, just it's $500 to buy the fundamentals course on our website. I'll even show you what's included in it. It just from start to finish, you understand everything. I go through economics first, because that's where you have to have your foundation. You have to understand the difference between macroeconomics and microeconomics. Then we're going to go through central banking, so you understand what drives central banks, and then that's what moves currencies and basically everything. How to understand what moves NASDAQ specifically, and then how to trade news releases step by step. Members, no, not the Forex textbook. Forex course, trading news. There it is. So I went through and I looked at every single Fed meeting, and this is how I developed a big part of my NASDAQ strategy is watching these Fed meetings. And I basically went through and shit, that was close. So I basically went through every single Fed meeting I've ever traded, back tested it, found the average duration of each trade, found the average risk or drawdown expected if I want to trade this market, and I figured out a very consistent model. The Chart Addicts members, put a 1 in the chat if you see the model. It's clear as day. Every Fed meeting, no matter what, every Fed meeting has the same exact anatomy. Put a 1 in the chat, CA members on the Zoom here. If you guys see this. Every Fed meeting, same anatomy, same anatomy, same anatomy. And once you recognize it, put something in the chat. Let me know that you see it. Come on. Guys, less than half of the responses. Let's get going. Unless you're driving. Don't hit me with the sorry, bro, I was driving. Ain't no sorry, bro. Don't fucking crash. I'm literally talking to everybody else who's got their hand in their pants right now. We got 2 minutes till the Fed meeting. Got to make sure we get this out the way first. Okay? Said Dubai's about to be a movie. You guys have no idea. Dubai is going to be one of the most incredible experiences. If you guys haven't already secured your seats to the FX Summit 2024 conference, click the link in the description below. It's the #1 conference for traders. If you're a trader, there's not a lot of events in the world for you. This is going to be it. NASDAQ already moving. Wow, if only there was a stream where somebody called these kinds of trades. If only there was a group chat where these trades were called in advance. It's really hard to see. That says 301. Please believe me, guys. Okay, it's 301. Okay, take my word for it. All right, members got it. If rates continue high, okay, we got 2 minutes until Jerome Powell hits the stage. Let's get focused. Here we go. January, then we have June, April, May. Here's the statement. We'll go through the statement in detail here, but no change. Minimum bid rate of 5.5 for repo or overnight repos. Aggregate operation limit of 500 billion, 5.3% counterparty for reverse repos, 160 billion a day. Not bad. A little bit more money into the system. Let's get on the press conference and then we'll go through the statement after. Actually, forget the statement. He's going to explain it here in a sec. Let's go. Can you guys verify that you can hear the shitty, the shitty Fed music here? Let me know. Can you guys hear it? Can we hear the music or? Hello? Let's try again. All right. Well, now it's not playing, but what about now? Well, now there's no sound. Let's try this again. Okay, well, now it's muted. Could you guys hear the music before or no? Like at all? Any music ever come through at all? Not even a little bit? Okay.
No.
Oof. That's a Please don't do this to me today. Come on. Let me know if you can hear him at least. I'll put on the captions just in case. Can you hear it?
Good afternoon.
Still no audio?
Remain squarely focused on our dual mandate to
Okay.
promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal.
There it is.
Restoring
Catch my
price
drink,
stability
take a
is
shot every
essential
time
to
he
achieve a
says.
sustainably strong labor market that benefits all.
Oh man.
Today, the FOMC decided to leave our policy interest rate unchanged
Shocking.
and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration.
Immigrate. Okay, I'm so glad he at least was honest enough to do it, to say that immigration had a huge role in the improvement of the amount of people willing to work in the country.
Supply of available workers.
There it is.
Inflation has
At least
eased
he's
notably
honest,
over the
for
past
God's
year,
sake.
but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our
Yo, who's
mission.
up on this trade?
We at the Fed will do everything we can to achieve our maximum employment and price stability
What about
goals.
that tester entry
Thank
in?
you. I look forward to your questions.
Wow, just wow.
Schneider with Reuters. A question to follow up.
Solid work, Jay Powell. Didn't say a single thing, but let's get to work here. This is the fun part of the press conference where they ask him hard questions and he panics. Let's see what happens. I'm very bullish, guys. Very
Evidence
bullish.
shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful? And ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to.
First off, hold up on whatever Jerome Powell is saying. Yo, all this stuff in the group chat right now, in the comment section here on Zoom, guys, cut it out. It's one trade. We literally do this every day. There's one of these trades every day. Okay, now does it always move in like 3 minutes and we just get to cash out and leave? No. But we do this every day. Y'all better cut that FOMO shit out that shit's contagious.
answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored
Or anchored.
stable, roughly? Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but
Bro,
I would
that's your
say
whole
that,
job.
we're committed to retaining.
He just asked them a real quantitative question. He was like, yeah, so we're not actually going to be specific. We're just going to keep being vague. Are you fucking kidding me?
Yeah.
Chris Brown said, listen, I just passed my funded futures.
Chair Powell.
Yo, W
wonder,
Chris in the
obviously,
chat. Congrats, Chris.
Michelle Bowman has been saying
Congrats,
that there
everybody.
is a risk
Yes,
that rates
we're
may
winning.
increase further,
win.
although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
Hey, put the mic a
So
little bit
I think it's
further away.
unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our
Bullish.
policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing. As
Yo,
I
I gotta
mentioned,
write this
but
shit down.
something like that is what it would take. We'd look at the totality of the data, answer to that question.
Yo,
That would
we're
include
up a
inflation,
bag.
inflation expectations, and all the other data too.
Bobby said up 1.2K, just took majority partials, closed partials for sure. Made 4K though, can't trip. Of course you can't trip.
Well, I think that, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that. So it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example,
He hasn't taken his eyes off the book one time. So normally he does read off the book, but he'll also explain in detail off script. He has not gone off script one word. Even though he's making eye contact, it's kind of like when a preacher's at a pulpit, like he's reading directly off of his notes.
to hold off on rate cuts. I think there's also other paths that the economy could take.
They're not taking
which
any
would
risks
cause us
today,
to want to consider
which should
rate
tell you
cuts.
how
And those
important
would
this
be
is
two
of a
of
meeting.
those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly.
Hey, you guys remember last week when I kept saying that I'm bullish on NASDAQ and everyone's like, but Ryan, there's a recession but it's 3 bearish days in a row. And I had to fucking make public announcements left and right about why buyers are still in control. And I made a whole tweet and I posted about it and tweeted about it and wrote posts about it and did hours of live streams about it and let everybody from the rooftops know about it. That I was still bullish on NASDAQ about it. And then everybody was telling me, no, the market's going to crash. Crash where? I'm sorry, getting ahead of myself. I'm not just excited because I'm obviously up a fucking bag today. However, I'm more happy that the fundamental framework that we built to understand directional bias and how the market was going to react this week, kind of expecting bearish action early. I said this on Sunday. Go back and watch the Sunday stream. Expecting bearish action to trap all the sellers early, get everybody to start short selling into the trend. And then the meeting happens and we have this massive spike to the upside. Thank you for the liquidity, short sellers. We've been screaming this from the rooftops. If only there was a platform where somebody literally spelled this all out. Oh, wait. There it is. All right, guys. Obviously a little bit hyped up. Let's get back to Jay Powell.
I don't know that there's.
Make sure you're taking partial profits. Don't be, don't overstay your welcome. That is the stupidest thing you can do is get a 15-minute candle that just takes you all the way to nirvana and you're like, not enough. Okay, so make sure you have a strategy for securing and taking money off the table, and who knows, let the rest ride if you're able to. If you're trading an account where you can't hold swing trades or can't trade news, okay. If you're trading a margin account, hold it. Hold a runner. Why not?
The appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating.
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year, very strong growth, a really tight labor market.
We don't target the labor market. Your top two incentives or your top two mandates are price stability and maximum employment. Maximum employment is the labor market.
Supply side distortions and demand side distortions. And there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either strong either growth or a strong labor market in and of itself would automatically create problems on inflation, because
That's not
do
true.
that last year.
That's not
You asked about
true.
wages. We also don't target wages. We target price inflation.
Okay, guys, he's starting to piss me off. The number one metric that we've all been talking about to look at inflation is wage inflation. If people keep getting paid more, prices are only going to keep going up. They can't come down if people keep getting paid more, because the wage inflation is starting to keep up with consumer inflation. And this is the number one threat for the Fed, which is why the Fed said that people got to lose their jobs this year if we really want to see that 2% inflation number. So it's very much linked, and it's very much the number one most important focus for at least U.S. domestic policy as it relates to central banking.
Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Good question.
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking, you know.
Yeah, Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, you know, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think I mean, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And, you know, I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial.
I'm trying hard because I know I got a few comments about this last time. I'm trying hard not to interrupt him all the time, which I'm literally doing right now to tell you that I'm not going to interrupt him all the time. But my job is to add commentary, and if I feel like he's being dishonest, if I've looked at the data that suggests otherwise, I have to step in. So bear with me here. That's going to happen. So if you're new on the stream, I'm not sitting here trying to superimpose my own opinion over Powell's, but clearly as an appointed, not an elected, as an appointed official, he does have other agendas. And so I'm going to make sure I clear up any inconsistencies or misconceptions that he might try to purport from his position of influence.
To provide accommodation to the economy, but
or what, like Mike said, Powell capping.
Really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Greg.
Greg Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time?
You can tell he doesn't know a goddamn thing about markets or the economy based on how he just read that question.
All I can say is that
rip him a new one, Powell.
We've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point,
Christine, what did you just say? You said 4,200 on your funded challenge. I'm done for the day. I know when to stop. Thank you so much for the masterclass, Roy. Christine, so proud of you. And ideally, you took that higher time frame trade that we were looking at yesterday. So seriously, very proud of you. If you guys signed up for the masterclass, we're going to cover all the trades of this week, all the bangers of this week, TP1, TP2, all the trades of this week. We're going to cover them on the masterclass. You guys can see this amazing first push, and then we even caught the retest perfectly, and we caught 2 trades from this range up here. It's been an incredible week, guys. Had a bit of a losing streak before this. This week completely ate that losing streak alive, and we're really back in the game. So that's how it works. This is really how trading works.
And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the key one.
Again, we're going to have 1 to 2 rate cuts, if that, and they're all going to be 25 basis points. So it's not going to change anything about anything, except for once the Fed starts cutting, I think that the market is going to be very excited. So maybe they're pricing that in early because they're going to expect a cut at some point. But the start of a new cycle always begins the new 3 to 4 month directional trend. And so that when they start cutting, we have another 4 or 5 months where things are going to be moving bullish, and I'm looking forward to that. But it's not going to have a meaningful impact on anything when they cut rates this year, because not like mortgage rates, credit card rates, lending rates for cars, nothing is going to get cheaper.
I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation. And it was, 10%.
You see how he said that? He said, well, I was around for stagflation.
Inflation.
Talking
right
to
now
shit.
we have, and very slow growth. So right now we have 3% growth, which is,
that's good.
Pretty solid growth, I would say.
That's good.
By any measure. And we have
If
inflation
true.
running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation.
All right, talking shit. Guys, make sure that you guys hit the like button real quick. It takes 2 seconds. I'd appreciate it greatly from the bottom of my heart. Just hit the like button just so that this stream can get shared to more people and then people can get more quality information. Appreciate you guys.
Potential growth has moved up, and of course, he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are 2 questions. One is,
yeah, he's pissing me off. Actually, let me hear his answer first, then I'll give you my take.
Longer run trend. I don't think we know that. In terms of potential
Just spit it out.
though, if that's a separate question, we've had what amounts to a significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation, also through immigration.
Oh my God.
So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year. And last year for that matter too. So I think in that case, but you've also got.
Look, the big difference is there was a seasonality effect. So why was productivity growth down in 2022? Well, number one, we just went into quantitative tightening and we started to raise interest rates. So that was a big hit to productivity growth. And also 2021 was so massive because of the response to COVID that it stimulated things at a massive scale. Like you're not going to be able to meet those productivity the same productivity numbers because we were coming off COVID, which was a horrible sort of downtrend. And then in 2023, we had a massive reuptake. Why? Because 2022 was shit. And then even a little bit of a progress from there makes it impressive. The thing that's impressing me is 2024. The fact that we are sustaining this productivity, I think, is awesome. And so that's what he really should have led with, is fuck the seasonality effect or just the circumstantial effect of the last 4 years. The fact that we're past all that and things are looking good now, that's the soft landing. And I really think he's got to lean into the soft landing narrative.
And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state.
He rounded down for
So
he rounded down for GDP and he rounded up for employment.
And I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion?
By the way, we are going to absolutely smash through this target. So what I'm going to do now is I'm going to update the target here on NASDAQ to the next area of interest. And so just keep that in mind here. Let's get back to this.
3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher
below the belt
to an election?
Sheesh.
And similarly, is there
Good
a
question.
significant economic difference between starting to cut in say September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things. And if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then,
damn, I almost believe him. Isn't that crazy?
whether you start in, say, September versus December. And
there's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
And I'd love to believe that the Supreme Court and that the Fed are independent and that they don't get
Thank you, Chair
politicized, but
Question about the labor market.
I just
You've
can't get
mentioned a few
myself to do
times
that.
that the labor market is
That would just be
normalizing. Certainly
intellectually
today's
dishonest.
JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think roughly. So yeah, I mean, it's that part of it is bumpy. And again, we don't target wage increases, but it, in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress.
They're not a private entity, they're a non-government agency. So yeah, technically they're a private entity. They were started as a conglomerate of the largest banks, and they're basically the mafia of the 5 to 7 largest banks in America and their interests, and using those top 7 banks to pump money into the system and to use those banks, those commercial banks, as the bridge between the money printer and the people. And so it is a private entity. They do take into consideration, but they do work for the people and they're appointed by the president. So it's a non-government agency, but it's kind of like the CIA. They're not accountable to the Congress. They're accountable to the president. But I mean, no, the Fed is technically their oversight is from the Board of Governors, and the Board of Governors oversight is Congress. So technically they're a government regulated entity, but they're not a direct government agency.
And suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid in the
Alfonso, no. The whole game is buy low, sell high. All right? Not buy high, sell low.
I think headline core PCE peaked at 5.8. Now it's anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Cook them.
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy.
No, Mike, the Rothschilds don't own the Fed. The Rothschilds were the original Bank of Europe that seeded the Bank of Morgan, which became JP Morgan later, which was one of the founding kind of pillars of the Fed. So the Rothschilds gave the debt or the money to the Federal Reserve. But ever since we got off the gold standard and kind of started printing our own money, we sort of decoupled from that. We have the ability to print our own money and create our own debt. And so we've kind of left that old system. We owe ourselves and we owe a bunch of other governments money, but not necessarily these private banking entities.
So I guess 2 questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And
yes,
how
bro, I love the Gen Z questions, bro.
will be helpful on the inflation front in the coming months?
God, I love these questions. This is what all of the young people are thinking. Like, but what are you talking about?
There are a number of places in the economy where there's
So
where there's
good.
lag structures built into
Great
the
job.
inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low.
No, market rents is a survey of what people would rent their house for if they were to rent based on comparable. So it's not an actual metric of rents. It's not, and that's why CPI looks so low. When if you look at the actual rental prices, they're going up.
Into rents for tenants who are rolling over their leases. The landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, you know, it's complicated, but the story is it just takes some time for that to get in.
Yeah.
Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expected that this will happen.
Thanks.
That was really interesting. I'm going to note that at the very end here. We're almost
Thank you,
wrapped
Chair
up.
Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine.
They probably have one or two more questions. This is a longer press conference than usual, so this is good.
In developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
The toughest question yet.
So that you're right. I think that
Well, it's not a
that
tough
may
question,
happen.
but it's because
And
it was general, but this is good.
sort of domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates. Whereas I think other jurisdictions may go before that. In terms of the implications, I think
he knows.
Obviously, markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Nice. Good stuff for the emerging countries. This is really good for them.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy? Or is some softening in the labor market and the economy likely to
God, I love these questions.
So you're right. I
They're
think we
crushing
thought
today.
and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without, significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but, you know, it had to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
So close. Yet
Chair
so
Powell,
far.
thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table.
Wow.
As you had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by
Bitcoin's
saying
moving
that
exactly
the
according
Fed
to
is
plan. We
committed
had the
to,
relief bounce after the
completing
halving,
this
and then now we're
process
having that dip.
and
But like I said,
carrying out
dip
Basel
first,
III endgame in a way that's
then
faithful to
recovery. So
Basel
dip
and
first,
also comparable to
recovery,
what the
and
other
then
large
drop.
comparable jurisdictions are doing. We
Perfect.
haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve?
Quick reminder that the NAS 100 masterclass starts in about 4 hours. You have a little bit more time to go and secure your seat. Click the link in the description or head over to chartaddictsfx.com. Click the link that says live classes. Register for your seat to learn this strategy for yourself so you can recreate the success, not just whenever we're on the streams, but on your own time, and to take your future into your own hands. Click the link in the description. Make sure to register for the class. You got a few hours left. Don't miss out.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of...
Asking how long Jerome Powell has. He basically changes with the president appoints the Fed chairman. So Trump has already indicated that he plans to get rid of Jerome Powell. So the president appoints and then Congress confirms. So that's how Fed chairmen change their roles.
Listen,
because they're not an elected official; they're an appointed official.
Yeah, my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't, and it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work.
Mike's asking if the reason we're beefing with Iran is because they don't have their own central bank. Not really, no. They don't have their own central bank because they're kicked off the SWIFT payment system internationally, and so they have to go through dark pools of money. That's why they're joining the BRICS alliance, or trying to at least, because they got kicked off of the international monetary system. The real beef we have with them is, number one, we removed the Shah of Iran. President Jimmy Carter kind of had a role in that. So did the CIA, which basically brought power to the Ayatollah. After we toppled the Iraqi government, I think we kind of had a plan to go topple the Iranian government next. The Ayatollah had other plans. Their sole sort of objective is toppling the Western world and creating their own sort of Islamic regime, and just decoupling themselves from the American system. They're very, very aggressive against America. We want their oil. They want access to the Mediterranean. We're blocking them using Israel to get access to the Mediterranean. There's a lot of small, or not small, even huge sort of differences. And one of the bigger differences, now you're getting into cultural, religious, where America's sort of teamed up with Saudi Arabia, which is a counterbalance to Iran just because of certain religious and cultural differences. So America and the West teamed up with Saudi. Iran is trying to basically maintain the Islamic sanctity of the Middle East. And so a lot of problems there. It's not about the central banking, that's for sure.
Thank you very much.
Okay, great press conference. I'll go ahead and check if there's anything important at the end, but really to go through the main points. Number one, the strategy is goated. Make sure you guys click the link in the description to learn this strategy. Masterclass starts tonight, 4-day live masterclass. Come learn this system start to finish. It's a little bit, it's a bit much, but if you're serious about trading and you're serious about learning a system that you can repeat over and over again, when everybody else is confused about trading news and they're all panicking and they're all talking about losses, we're very patient, we're very calculated, we have a very clear system and waiting for very, very specific things. And so we're never in a panic. If you want that to be you guys want to get off the hamster wheel of inconsistency, click that link. We'll see you guys there. Main takeaways from the Fed meeting, just to kind of wrap this up. Obviously, Jerome Powell is still talking about the 2% inflation target, but he did mention that they're having a bit of trouble getting to that 2% inflation target. My concern is that if he's starting to get soft and he's talking about rate cuts while inflation is still surging, that's going to create massive problems. So the asset inflation bubble, where rich people are getting richer because they own stocks, houses, bonds, they own real estate, that's going to, the wealth gap will continue to blow up if that happens. And then even worse, consumer inflation gets a lot higher. And so middle America and lower income America gets hit the hardest because they just have to pay more at the grocery stores. Okay, so this is going to make inflation surge right back up. It's going to lead to the asset inflation bubble exacerbating. And I think that this is just going to be a problematic path for the Fed. So if they're smart, they're going to have to stay higher for longer. And that is not going to be a, how do I say, it's not going to be an optimistic thing for the market to deal with. All right, when he realizes that they really can't cut rates in an environment where we're struggling to, to get down to that 2%. Mike says it's deeper than I thought, but it goes so much deeper. The proxy wars, the CIA's involvement in the toppling of Khomeini, and or not the toppling of Khomeini, but the toppling of the Shah Reza Pahlavi, and then Khomeini took over. It went from a secular government over to a religious kind of theocratic government, and that's kind of where the issues have been there ever since. And then Iran is sort of kind of counterbalancing the Israel situation. Israel is sort of our proxy in the Middle East to counterbalance Iran's dominance, and it's just become this whole thing. That's why when when Saudi Arabia was about to sign that deal with Israel, kind of like a peace treaty and a business treaty with the United States, that's when Hamas conducted the October 7th attacks and basically ruined all chances of that happening. So it goes so deep. Now, back to Jerome Powell's, the priority of domestic policy versus the international and global impact of central banking, I think was a major point to pay attention to. Because the big deal is, he mentioned that our advantage is that we have a strong economy and they don't. That's why we can kind of do stuff that they can't do. But just say, I mean, obviously you can't say the quiet part out loud, but I can. So I will. The quiet part is we can do whatever we want because we're the global reserve currency. And so if we raise rates because we need to for our economy, screw everybody else. They're going to have to follow the pace because they can't do a divergent monetary policy unless they want to crush their economy. So they have to follow with whatever the Fed does. And that's why I loved that young lady's question. Her question was, what is your take on the global impact of central banking policy? That's what led to BRICS, by the way. Brazil, Russia, India, and China, and some of these other countries teaming up together. Why? Because they no longer want to be beholden to the decisions of the central bank of the US. Because as you just heard Jerome Powell, yeah, they take into account the global impact, even though he said they don't, but their priority is domestic policy, maximum employment, and price stability. And that is a huge deal because that's bullish for NAS, by the way, because if you're like, we're going to do whatever it takes to protect us, and we can, and screw everyone else, that means they're going to start going through real problems. even less reason to invest in global equities and even more reason to invest in US equities because it's going to be a more attractive and safer place to park your money. So I think that Jerome Powell is indicating optimism and things are looking good. He's buying time. The thing about macroeconomics and data is that it's quarterly and annual data that really helps you understand the greater trend. So even though we can get caught up in individual releases, it's really like, let's look at the next 2, 3, 4 months of inflation. And if it's getting better, then whatever I said now doesn't matter. We can cut because we're in a different, we're in a completely different environment. But that's why, even though we give Jerome Powell shit for saying data dependent, you really do have to be data dependent and you do have to be flexible. My favorite question is the last piece, by the way, before we hop off. My favorite question is, oh God, what did she say? It was something about data dependence. It was, they got to be flexible. It'll come to me. We'll talk about it later. Yeah, we'll talk about it later. We'll do a whole session on the labor report to look through where are all the jobs, which sectors are the job gains at? Is the job growth that we're seeing because of, these incredibly great policies? Or is it because we have so much illegal immigration? These job numbers are showing up and the economic situation is so bad that a single source of income is not enough and people are picking up 2 jobs. That's why the jobs numbers makes it look like so many new jobs are being added, when in reality, the unemployment rate might be way higher than 4%. Right? What if it's at like 10%? Because I saw this private report that I will share with you guys during that live stream that shows that the real private data report shows an unemployment rate of close to 20%. We'll talk about that, see if there's anything legitimate to those claims. Last reminder, make sure to register for the live class tonight. It's a 4-day masterclass. We do it every 30 to 45 days. The next one's going to be in June, mid-June. And so that's when May and June are the most volatile times for the markets. It's really just April, May, and June. All right. It's already May 1st. If you guys want to get consistent, learn something that works, and then make the most out of the next 2 months of volatility, this is your chance. If you guys want to wait until the next one, you're going to basically just end up with summer volatility, which is very slow, and you'll have to basically just study and practice until volatility comes back in September. All right. So I recommend do not miss out on this opportunity. I know it seems like it's expensive or whatever it is. It's more expensive to keep failing challenges. It's more expensive to not make $1,000 a month, which you could be doing if you just got your act together and learned a system that works. See you guys tonight. If you're already registered for the class, the link is in your email. And if you guys have any questions, keep them to yourself because I'm busy. All right. Just jokes. Like and subscribe. Catch you guys later. Check out the new videos on our channel. Brand new podcast with our student, Jonathan Rodriguez. Check that out. Peace. All right, members.